Hello everyone, wherever you are. Welcome back to Deloitte Canada's transfer pricing series on financial transactions. I hope we are all eager and ready to visit the first branch of the complexity tree. I'm excited to introduce Andreas Ottosson, a transfer pricing specialist and financial transaction expert with Deloitte in Calgary. Andreas will help us navigate the global audit trends with a specific emphasis on the insights from the field.
Transfer pricing matters associated with intragroup financing arrangements are receiving increased tax authority attention and scrutiny. We've seen a number of measures implemented to address aspects of these issues across the globe. For example, in Canada, we have significant case law including Capital and McKesson, as well as changes to our statutory think cap regime. More recently, the Organization for Economic Cooperation and Development's Base Erosion and Profit Shifting project includes specific actions that could lead to further unilateral policy and legal changes, fueling the increasing complexity and controversy in this space. In our experience, transfer pricing audit controversy often occurs because of fundamental disagreements around a few key concepts: creditworthiness, comparability, and commercial reality. In audit, we seem to have consensus that the comparable uncontrolled price, CUP, or transaction, CUT, is the most appropriate transfer pricing method to use to determine arm's length interest rates. We also seem to agree that creditworthiness is an important concept. However, we do not always agree on how to arrive at the appropriate estimate of creditworthiness. For taxpayers and tax authorities alike, this often starts by using one or more credit rating estimation tool or model. There are industry-specific rating methodologies available that employ a combination of qualitative and quantitative metrics to estimate a rating. This should be contrasted with tools that derive results based solely on financial statement data. So which tools do you choose? What is the difference of trying to understand industry-specific creditworthiness attributes versus having an entirely data-driven tool to determine an estimated rating? For one, the various methods do not necessarily produce the same results. Since we do not have specific rules or guidelines in Canada to inform the selection of a rating estimate tool or model, these differences can cause significant friction between taxpayers and tax authorities. We have seen companies deriving an investment-grade estimated rating using one model and a rather low non-investment grade rating using the other. We are not advocating for either methodology, but rather to stress the importance of proactively seeking to understand, bridge, and document that gap, if any. In short, that is best practice. Another significant aspect of a creditworthiness analysis is the impact of implicit support. In Canada, we have specific guidance from jurisprudence, but we have also seen other tax authorities verbalizing similar sentiments around parental support, implied or otherwise, most notably the Internal Revenue Service and the Australian Taxation Office. From an audit perspective, this means a dialogue around potential rating uplifts and the resulting downward pressure on the selected interest rate. Again, proactively analyzing and documenting your position around implicit support is best practice, even in jurisdictions that do not currently have specific rules or jurisprudence to guide you. The outcome of an audit often stands and falls on issues of comparability. This is clearly not a surprise, given the comparative nature of the arm's length principle, but we have gleaned some insights from the field that we hope can be useful to you. Perhaps rightfully, tax authorities focus on the existence of internal CUPs. We've seen instances of proposed adjustments on the basis of an internal CUP that arguably should not have been considered a CUP at all. The comparability of group external debt is a matter of frequent controversy in audit. For example, what weight as a CUP can we attach to group financing arrangements wherein the intragroup borrower is not the co-borrower or party? We have also seen attempts to rely on apples to oranges comparisons, such as supporting the rate on a term loan by reference to rates of revolving loans. We've seen tax authorities disregarding selected external comparable instruments. For example, in situations where the taxpayer has elected to rely on bonds to determine arm's length range of rates for plain vanilla term loans. Ultimately, this all comes down to a careful review of relevant terms and conditions and a detailed comparability analysis based on those findings. This is not news, but I'm surprised by the amount of time spent debating these issues in audit. As a matter of necessity, a transfer pricing analysis to determine arm's length interest rates usually includes certain common comparability adjustments. For example, adjustments to account for differences in term, credit rating, payment frequency, and embedded options. It is important to understand how these adjustments affect the ultimate range, because we've seen several audits where they have been disregarded. The commercial reality of an intragroup loan often causes friction in audit. In broad strokes, we've seen challenges to reduce debt levels with reference to the commercial reality of the borrower's debt capacity. Conversely, we've also seen tax authorities attacking claims of debt subordination without any regard for arm's length senior debt multiples and market covenant. Another trap is present in this context: hindsight. In our experience, interest rates are often audited several years after the loan was executed, and it is very difficult to disassociate current facts and perceptions of financial performance and stability with the most reasonable projections available at the time of the transfer pricing analysis. It is best practice to carefully document market conditions and other relevant factors that influenced your assessments at the time of your analysis. In closing, best practices informed by insights from the field should be employed when designing, analyzing, and documenting your intergroup financing arrangements. This will assist in reducing audit friction and controversy. Thank you for watching, and I hope these insights prove useful.